The answer would be to develop alternative information sources. You don't just take manager's word for it. You need to develop alternative routes to get information, because things can pop up.
Welcome to The Alternative Investor, the definitive show for investors seeking private alternative investments. Here's your host, Matt Johns.
I'm excited to share an in-person conversation I got to have with Chadd Garcia, Vice President and Portfolio Manager at Ave Maria Mutual Funds, the largest Catholic-oriented investment company in the U.S. Chadd is responsible for their Focused Fund, a fund that seeks long-term capital appreciation from a small, focused number of equity investments in companies that don't violate the core values and teachings of the Roman Catholic Church. It's received many accolades, including being recognized as a category king by the Wall Street Journal. Chadd has had a remarkable career. After growing up on his family farm, he started his career in agriculture, but that quickly shifted when he became an associate in the Mergers and Acquisitions Group at CIBC World Markets. He then moved into private equity, serving as vice president at Comvest Investment Partners and then managing director for multiple investment firms. Now, I want to offer a quick note on Ave Maria Mutual Funds. They offer a diverse group of 6 funds that enable investors to align their financial goals with their moral beliefs, placing equal emphasis on both in their selection process. They screen out companies that promote or support activities contrary to the core moral teachings of the Catholic Church. It was among the first funds to offer this, so this was a big part of our discussion. Now, Chadd himself is widely recognized as an expert in public equities. You may have seen him on Fox Business, the TD Ameritrade channel, Cheddar News, or the many different radio shows and podcasts he's been on. It was great to be in person for this. In fact, we're in the hotel lobby where he was staying, so you'll get to enjoy hearing some of the activity around us. Welcome to my conversation with Chadd Garcia. If you were to go back to 10-year-old Chadd, what would you tell 10-year-old Chadd? And then maybe what do you think 10-year-old Chadd would tell you?
Well, first thing I would say is to buy Texas Pacific Land Corporation, because that stock's up 550-fold since I was 10 years old. Not 550%, 550-fold. So wow. Yeah, I'd be much better off if I would have done that instead of buying comic books or toys or whatever.
The Back to the Future Almanac, right?
Yeah, right. But, this is a hard question because, in some sense you want to enhance your life now, if you had a chance to learn some lessons. But, the people that we are today, you've developed that because of your experiences, whether they've been, tough lessons or a little bit easier. But I think I would tell my 10-year-old self to stay independent, be independent. I wasn't really much of a crowd follower back then, and I think that suited me well then. But as an investor, to think independently is probably one of the best skill sets. And then I would remind him to be humble in life. And, I got involved in finance, and finance is very competitive. I went to, competitive graduate school, and, those are types of people that strive for those types of activities. Humility is not something that, may come natural to them, but in investing, it's good to learn and even learn from your mistakes, because you'll make them. Mm-hmm. And being humble is helpful for that. So I'd remind my 10-year-old self to be humble.
And what do you think your 10-year-old self would tell you?
Well, my 10-year-old self was very curious. I mean, you had the space shuttle program was going. I was interested in science and space. I was a curious person, and staying curious is also helpful for me as an investor. So I think my 10-year-old self would say stay curious.
Stay curious. That's probably something we should all do a little bit more of. And as I'm thinking about you, I know that your faith is incredibly important to you and who you are as a person. But it also plays heavily into your investing, especially now at Ave Maria Mutual Funds. One of the things I wonder is you're diving into these companies. There are a lot of implications within these companies. So how are these investments kind of shaping your faith and informing your faith and the way you approach life in general?
Well, at Ave Maria Mutual Funds, we want to be able to help our clients grow their investments, and do so in a manner that doesn't conflict with their faith. And so we look at making good investments from a financial returns, but we also make sure that the companies that we invest in don't violate the teachings of the Catholic faith.
Right.
And so great investors, often say, when you're making an investment in a company, don't think about buying a stock as buying a piece of paper. think about buying a stock as a piece of ownership of a larger business. And I think that is great advice from making a good financial investment, but it's also good advice for making an investment that aligns with your faith. If you're owning a small piece of a company, like, are you proud of the activities that the company does? And, we don't want to own companies that would conflict with the teachings of the faith, but also we want to be, proud of what our companies do.
Yeah. So tell me a little bit more about Ave Maria Mutual Funds and brag a little. You guys have won some awards. You've done some great things. Tell us a little bit about the company itself.
Right. So the company was founded, Ave Maria Mutual Funds was founded just over 20 years ago. The company, Schwartz Investment Counsel, that is the firm that manages the Ave Maria Mutual Funds, which is a firm that I worked for, was founded in the early 80s. And so we have got a multi-decade track record. There are 6 funds currently within the Ave Maria Mutual Fund family doing various strategies. 2 of them have won Lipper Awards on various occasions. The Ave Maria Value Fund, which I used to be a co-portfolio manager of, has been in the Category King section of the Wall Street Journal numerous times. The Ave Maria Focused Fund, which I'm the lead portfolio manager, was in the Category King section of the Wall Street Journal several times last year.
Which is awesome.
So no, it's great. I mean, I think the Wall Street Journal, had maybe 550 other funds in my category, and so you had to be within the top 10 of those funds on a performance-wise to be in it. So
Yeah. Well, tell me more about the Focused Fund.
Well, the Focus Fund is it's not unique, but I would say it's rare. It's a legally non-diversified mutual fund. So if you look at a mutual fund industry-wide, they may have 50 to 100 holdings within the funds. Our funds concentrate a little bit more, so we're be maybe in the 25 to 45 holdings range, so less than the industry. The Focus Fund can be much more concentrated, and I look to have between 15 and 20 holdings at any given time. Right now we have 14 holdings. Do very deep work on the companies. We know them well, and we want to buy companies that are going to at least double in size over a 5-year period, and buy them, pay a reasonable price on the way in, and then let them do their thing over time.
Now, you use the term legally non-diversified. I would imagine that's not a common phrase that most people use in their daily lives. How do you, what does that mean?
Well, the government has diversification thresholds for funds, and so my fund has a higher concentration threshold than the average one.
Yeah.
So I can't own more than cumulatively my 5% or greater positions can't be cumulatively greater than 50% on the purchase. Now, if they appreciate to be over that, they can grow much larger. And right now,
Sure.
I am significantly over the 50% because my holdings have appreciated in value.
Yeah. Which I'm sure makes a lot of people very happy. So who is this fund, specifically your fund? Who is it for?
I think it's more targeted towards ultra high net worth and institutions. You're going to get with it most likely a little bit more volatility just because there's less holdings, but there's a better chance for outperformance because we can concentrate on a select few ideas.
Yeah, and you like to hold for a little bit longer, right? It's not a day trader kind of strategy.
No, it's definitely not a day trader strategy. We'd like to hold, ideally forever, but things happen.
Yeah. So now, one thing I've noticed about you is you love talking investment strategies. So, what is it about diving into companies that gets you really excited?
Well, there's the research component that's exciting. Kind of finding a diamond in the rough. If you're going to make an investment, you have to figure out if the company is a great business or not. And so there's a lot of research that goes into that. There's a lot of intellectual thought. And then you have to be able to buy it right. And so that means that you're recognizing something in that business that the rest of the market doesn't recognize.
Yeah.
And public market investing is probably the most competitive game in the world. And so that's not an easy thing to do. And so the search process for that is exciting. And then once you've found that company and you made an investment, to see that play out over time and have your thesis come true is pretty gratifying.
I bet it is.
And now it doesn't always come true, and that's when you have to make a decision to potentially exit it and find something else. But as that comes true, it can be pretty gratifying.
Do you have any triggers that lead to that kind of threshold where you're going to be diversifying or getting out of certain holdings?
Well, if the business quality is deteriorating, then it's a quick sell. I don't really care too much about if a company misses or beats on a quarterly earnings. I care about if there's any indication that the quality of the business is deteriorating, and if that's true, then it's an immediate sell. The second would be if my thesis turns out to be incorrect, and it could be incorrect for the stock could be going up, and I could be wrong, but it could be a positive outcome. Or my thesis could be incorrect, and it could be a negative outcome. Yeah. But if you find that your thesis is wrong, you might want to start questioning on if you want to get out or not. And then the third reason would be if a company becomes an offender. So we call companies that do activities that would violate the teachings of the Catholic faith and on our screens, we call them offenders. And a company may not be one when you invest in it, and then it may become one over time. And if that happens, then maybe you go to them first and ask them to change their activities, and if they don't, you sell it.
Yeah. Now you mentioned some diamonds in the rough earlier. Now, what are there any companies right now that you're looking at that you really think are the diamonds in the rough that you're really kind of excited about?
We bought a company in March, April this year. It's called Secure Energy Services. It was founded in 2007, it went public in 2009 in Canada. About half the business was infrastructure, pipelines, and a waste business that dealt with oil production in Canada. The other half of the business was oil and gas services that were tied to new drilling, which that's not really a great business. The infrastructure stuff is fantastic because it's very recurring revenue. The stuff that's tied to new drilling can be quite volatile, and it worked out really well for them from 2009 to 2014 when the oil prices in Canada were doing well, and then in 2015 when they collapsed, they saw the earnings of about half the business go to zero, and the management said, we don't want to live through this again. And they were able to survive, but they're like, we don't want to live through this again. So they ended up shuttering or selling all of the stuff that was tied to new drilling, and they focused on building out their waste business. And so they process the water that comes from the fracking of oil wells in Canada, and that business is a fantastic business. So the returns on invested capital and the margins are the highest in the waste space, and the company is still viewed because of its legacy history as an energy services firm. An energy services firm trade at very low multiples because people know that the earnings are going to be volatile and they can get in trouble. Yep. But that's not what Secure is anymore. It's pretty much an infrastructure company. And so I met the management team almost 2 years ago, and talked to them a little bit about their business, and then I did a little bit of work. I probably should have dug in a little deeper then. Then I saw them about a year and a half ago at a different event, and got to spend a lot of time with the CEO and the president, and really learn the business. And I was like, yeah, you guys aren't really an energy services firm. You're really a waste company. Like, you need to. Why don't you guys change your name? And I can see their kind of faces light up. They announced last month that they're changing their name. The shareholders are going to have to vote on it. That the name will be changed by January 1st.
Do you get royalties for that?
Yeah. Well, to the extent that I think our stock's up 35% since we invested in it. So, but then if you look at the sell side research coverage, so the Wall Street banks, they have analysts that cover stocks, and they send out reports to investors. And if you look at the analysts that cover the company, they're all energy service analysts. They need to be covered by the waste industry analysts. And so I said, why don't you get covered by the waste industry analysts? Like, we're working on that. So that's what they told me in March. Like, we're working on that. We're going to try to get that switched over. Here it is, November. In October, 2 banks initiated coverage on them, and they initiated coverage with their waste analysts. And so that process is starting to happen. The government, they did a merger which gave them 90% of all the wastewater processing capacity in Western Canada. So they effectively had a monopoly, and the government of Canada came to them and said, you need to sell down 20% of it. And so they sold down 20% of it, and they had a bunch of cash coming in. I'm like, your stock is really underpriced. You're trading it at the time 6 times EBITDA. Your waste peers are between 12 and 18 times EBITDA. You really need to buy back your stock. They're like, yes, we agree. We need to buy back our stock. And here it is today. They announced their earnings a week ago, and then they have bought back 19% of their stock. So that's a lot, And the stock is moving in the right direction, but it's certainly still undervalued. And so,
Gosh.
I'll do a podcast on him. An investor podcast on him next week, and maybe help get the story out. And I have a lot of friends, who are looking for diamonds in the rough too. So I'll teach my friends about the opportunity. Actually, I did tell to one of my friends who works at a fund, and he went up to visit the company in July and made an investment in it. So the word's getting out.
That's great. And that helps you out.
Yeah.
Now, you met with the management. This is kind of a unique position you get to be in, being a fund manager yourself. So how often are you meeting with the management for your portfolio companies? And then how much does that factor into your decision of how much, if any, to invest in them?
Well, we want to invest with good people. And so it is important to meet with management teams, but the larger the company gets, the harder that becomes. But I have one company in our portfolio that's a $70 billion market cap. I have another one that's it's close to $100 billion market cap. I've met with both of those CEOs, one time, but it's not like I can pick up the phone and call them. But most of the holdings in the Focus Fund are smaller. I mean, we're looking for good companies, but great companies, if they're larger, the market usually figures that out, and so it's harder to buy them right. I found that if you go a little smaller, you can find that it's a little easier to find the diamond in the rough. Now the $70 and $90 billion companies, those stocks are both up around 80% in the last year. So certainly the market's not not efficient, right? Like those were diamonds in the rough too. But I found it a little easier on smaller companies, and so when we're investing in the smaller companies, it's quite frequently that we get to meet management and give them our views on what they should do with the company, or be a sounding board for them. And the CEO for Secure, I've developed such a good relationship with him. When the hurricane came through Florida, he was texting me just to asking if I was all right, which was nice.
That is all. Wow, that's incredible. So, and now you've got a lot of private equity in your background too. As you're evaluating all these companies, how do you see your private equity background and that experience playing into your decisions with each of these companies?
Right. Well, I think that about 3 different distinct career experiences in my life. I had operation experience before I got into finance. I have had the transaction experience with investment banking and private equity, and then I've had the public market experience. And from a due diligence standpoint and learning about the companies, I think my prior operating experience, probably is of more benefit. But what the private equity experience does is help me focus on what's important. And in the public markets, there's a lot of noise. Like, your stock's up today, the stock's down today, the company missed, or the company beat, this quarter. But what really drives a successful investment is buying a good company, paying the right price, and having that company grow its earnings over time, and waiting for it to do that. And so private equity kind of helps you focus on those aspects. And when you're in private equity, if you're going to buy a company, once you do, you're in for a while. It's a very cumbersome process, an expensive process to buy and sell a business. So like, once you're in, you're in.
Yeah.
So you got to make sure that you buy right, and then as you own it, you're going to want to help the company grow its earnings over time, and maybe in 3 to 5, 7 years you harvest it.
Yeah. And you're focused on growth and fundamentals, or growth potential, I should say,
Yeah.
and the fundamentals of the company. Yeah.
Correct.
So now I do want to shift gears for a second here, because one of the great things about Ave Maria Mutual Funds is the moral adhesion that it has, specifically to pro-life and pro-family values. So and one of the things that you're committed to is being equally focused on the long-term investment potential and the adherence to the moral framework. Can you explain your process and how you conclude that an investment is right for any of the a mutual fund family?
Right. Well, any investment's going to have to fit with the goals of the fund that it would go in. And so the value fund is a mid-cap fund, so it should be mid-cap size business. The growth fund should be a growth business. The focus fund is growthier as well. We have a bond fund, so obviously fixed income. There's the financial component. Is this a good business? Does it have a defensible moat? Can you buy it right? Is its earnings going to grow? So that's one side. That's the financial investment side. Mm-hmm. And then there's the morals part of it. And from the moral screenings, we have a separate advisory group called the Catholic Advisory Board, and they set the policy for us. And they don't tell us what we can invest in or say that a company has to do certain activities. They just tell us what we can't invest in. Mm-hmm. And so their screens for us is they don't want us to invest in companies that produce or distribute pornography, that have anything to do with abortion, or participate in embryonic stem cell research. So those are the screens that they have set up for us, and we have a zero tolerance policy. So as a Catholic, it could be illicit to invest in a company that does some of those activities if it's immaterial. Right. But what is immaterial? And right. We don't want to set up a conflict between the investment side of the house and then like the moral screen side of the house. We don't want to have to make that determination on if something is material or not material. And so we just have a zero tolerance policy.
And when you say material, what do you mean by material?
Well, as a Catholic, you can't participate with evil. And if it's remote, then yeah, I guess it would be, fine. And so,
I know I'm putting you on the spot. It's not an easy question to answer.
Well, I would say that, take a look at Amazon. It's the everything store, right? Amazon is a fantastic business, and it is large. And they also sell pornography. Is it 1% of the revenue? Is it 0.5% of the revenue?
Yeah.
I don't know. They don't disclose it, but I would say it's probably de minimis. Mm-hmm. But it's not zero. So we want to invest in it.
Yeah.
Now, if you were, we're not going to invest in. We wouldn't be likely to invest in a power utility, but the power utility is going to sell to Planned Parenthood and a Walmart and you and me, and because they would sell to somebody that does objectionable activities, like would we not invest in them? No, I think that's a little bit too far. So that would be something that would be fine to invest in from a moral perspective. From a financial perspective, maybe not. But.
Yeah, but there are no degrees of separation that there's no objective degrees that you can look at. It's just kind of what percentage is it de minimis? Is it none? Is there? You're just kind of looking at it. However, subjectively, I don't know how do you determine that.
If they participate in any one of those activities, we're not going to invest in it. If it's 1%, it would be a no-go from an investment standpoint for us.
Yeah. Now, to that point, one of the unique things that you brought up is the voice that you have, the relationship that you get to have with management in these companies that most retail investors aren't going to have. But you've had some really neat experiences where you've not only been able to voice your investors' concerns, but there have actually been changes made. I'm thinking about one in particular where their servers were housing a very highly trafficked porn site. Right. And so maybe you can tell us a little bit about that story and how that came about.
Yeah, well, there's been several examples throughout the firm where the firm has voiced objections to some of the activities of the companies, and companies have made changes. But in this case in particular, we started investing in data center businesses around January 2015. So we've been in it for a while, and I've led the charge on that, and have learned the businesses pretty well. And when I was learning about the data center business, there's good data centers to invest in, and there's bad data centers to invest in, and one of them that would be a good data center was called highly interconnected data centers. And so this is where everybody comes to meet, it's kind of like the old meet me rooms for telephones, like the telephone switchboard. Like once you go in, you don't come out. And so let's talk about like what they would do. So let's say I have Xfinity cable, and let's say my daughter wants to stream Little Mermaid on Disney. How would Disney get the Little Mermaid to my daughter? They would put their content in a data center that's close by, probably Miami, and their content would be there, and they would have a rack, and that rack would have routers, and Xfinity would also have a rack there, and they would literally plug their rack into the Disney rack so my daughter could get the content. And when I was learning about the industry, I learned how that worked, because that is an indication of a moat. That's a good business. Like once you have one of these data centers set up where everybody's there and they're all plugged into each other, you can set up a data center across the street and say half off, and nobody
wants to go back and rewire that.
Nobody's going to go rewire it, because it would be disruptive. Imagine if Disney can't get its content to you. Imagine if Netflix went down. And so I was digging around in some industry stuff, and I found a database where I could find out where every single data center in the world where Disney had its content in, and from that, I could basically come up with a market share of interesting sites or interesting websites for this one data center company. And I looked at it and I'm like, well, this company's got 35% of all the Amazon sites, and it's got 35% or 40% of all the Netflix sites. Like this is a moat, and this is a good business. And then fast forward in the future, Visa was sued by some victims of Pornhub, and Pornhub, aside from being a pornography site, had massive amounts of child pornography on it, and they facilitated human trafficking. I mean, so not even from a moral standpoint, I mean, from a legal standpoint, anybody that was associated with that was at risk. And we owned Visa at the time. We ended up selling Visa when that news came out, and then because I had that knowledge of the data centers and how to find if somebody was in it.
So interesting.
I said, I wonder if Pornhub is in there, and I put it into the database. It didn't come back. I looked at, I put the name of the parent company in, and then it did hit, and it hit for two data center companies that we owned, and coincidentally, I was going to be at a conference where there's going to be senior executives of both of those firms there. So when I went to the conference, I went to the first company. They did the right thing, but they said they don't want their name mentioned. But let's just call them Company D. So Company D said, I said, listen, did you see this issue that Visa's having with Pornhub? Yes. I said, well, they're in one of your data centers. What? And I'm sure they didn't know. I'm sure it was like a very small customer, and they are. I have the proof. Please send me the proof. I will. I sent the guy the proof. Within 3 weeks, I got a call back. He said that Pornhub was out of the data center, and that they put protections in place to make sure that they wouldn't come back in via a third party. And then I went to the database that I had and checked, and they were gone. I went to the next company and I talked to the head of the Americas, and the response was, well, we don't really get into what our customers do. We don't really want to police that. If the authorities come, of course we'll cooperate. And I said, well, you don't get it. If the authorities come, they're not just going to investigate them. They're going to investigate you, because if you knowingly benefit from child pornography in this country, you are as guilty as the perpetrator. So you need to act. And then, they didn't act. And then I started writing letters to the CEO. And then then I brought in Lila Mickelwaite, who wrote a book, Taking Down Pornhub, and she's really been leading the charge to hold Pornhub to account. And she started writing them letters, and still to this day, it's still there. And we gave them plenty of time to rectify it, and then they didn't, and so we sold it, which is sad. I mean, we've made, we've bought and sold it over time, but I think this at least 4x our money over the period of time. So we did really well with it. And it's a fantastic business. I would love to be invested in it again, but if they're going to do that activity, then we're not going to be invested with them.
That's fascinating. And I love the way you integrate business A to business B to talk about not just businesses in and of themselves, but industries. And because you learned about Visa and you learned about how that industry worked, you learned about how this whole router system worked in the server farms, and you were able to figure out one meets B, or A meets B, and therefore make those connections.
I'm sure that they didn't even know that Pornhub was in their data center. I mean, which raises the question, like, why are you putting up a fight instead of just getting rid of them? Because it's probably like 0.1% of your revenue. It's nothing. But the legal and reputational risks that you're bringing onto yourselves by not dealing with this is immense.
Yeah. I love those connections that you're making. And I feel like, because I'm looking at things from the private market side, right? And as you're seeing this from the public market side, you're still having to dive deeper than most people ever would in any public market investment. What lessons do you think you've learned from that could apply at least as much, if not more, in private markets, from a diligence standpoint even?
Well, I think that the digging nature is kind of the investigative journalist approach is going to be relevant to both the public market and the private market investors. Like the advantage that the private market has is you have more access to management, and you can kind of get under the kimono, so to speak. Yes. I mean, I have to deal with just what's publicly available information, and I mean, I don't want any material non-public information. Like, we're going to buy and hold companies for a long time, so it's going to do anything for us. But private investors can get access to much more. So, but I guess the question is, or the answer would be to develop alternative information sources. I mean, you don't just take manager's word for it. You develop alternative routes to get information, because things can pop up.
Mm-hmm. What do you mean by find alternative routes?
Well, I mean, I went to a networking engineers database to develop kind of a market share report on this data center, and I can find out pretty much who's in the data center, and which is how I discovered that Pornhub was there. So that's not a financial analyst type of website. That's a website that's built for networking engineers.
No.
So
that's awesome. And I guess I just want to wrap up here, back to the private market side, I guess, a little bit, because you're so strong in the public markets, but you've got such a strong private market side too. Is there any recommendation or any other advice that you would recommend for people who are investing in private markets, especially when it comes to investing in line with their faith values?
Right. Well, I would say, I would ask, how are you going to invest in it? Are you going to buy a company yourself? So are you the private equity investor, or are you just going to buy a whole company yourself? Or are you going to do it via a fund? Either way, this is going to be a long-term investment. 5 to 10 years if it's just a straight private equity firm where they're investing in business. If it's going to be like an infrastructure firm, you're talking about 11 to 15 year lives. And so It's almost like a marriage. I would say, be very comfortable with whom you're going into business with. If you're buying a company, be very comfortable with management. If you're investing in a private equity fund, be comfortable with the private equity fund managers. Meet them, go out to dinner with them, see how they treat people. Look at their track record, ask them about their values, ask them about their investment philosophy.
You can in the private investment
You
world,
can,
right?
you can do that. Yes.
Yeah. Well, Chadd, that's terrific. Thank you so much for taking this time, and thank you for all you're doing at Ave Maria, and for all the lives that you touch, both on both sides of the equation now, both the investors and in the companies themselves. Doing great work. Thank you so much.
Thank you.
We hope you have enjoyed this episode of The Alternative Investor. If you found this valuable, please be sure to like, subscribe, and share. This show is brought to you by Honey Hive Capital Partners. Visit us at honeyhivepartners.com to continue your alternative investment journey. This recording represents the views and opinions of its guests and does not reflect the views and opinions of Honey Hive Capital Partners, LLC. Nothing in this recording, nor any communications from it, should be treated as constituting financial, investment, legal, tax, or other advice of any kind, or as a recommendation to buy or sell an interest with respect to any investment. We look forward to you joining us next time.